Hello, ladies and gentlemen. It's Jesse Colombo, Cyber Trading University's Forex and Futures instructor, and I'm very excited that we have an interesting webinar, closing bell webinar today with Keene on the markets, specifically James Ramelli, and he's going to be teaching how to use credit and debit spreads to trade earnings. And he's going to be basically teaching how to use measured move targets, also some of his favorite setups for company earnings reports, the types of catalysts that offer tremendous opportunities for low risk, high reward trades using weekly options. So I'll definitely be watching that with great interest. I always love these closing bells because I learn from so many different traders who have so many different viewpoints, and I find it really helps to synthesize all this different type of information together and eventually improve my own trading and my own analysis. So now I'm just going to do a quick update, quick market analysis before Jim starts around 4:30. So right now I'm just looking at the S&P 500. It's up slightly today. Let me just get my chart drawing tool. Here we go. So as many of you have noticed, I've been following this rising uptrend line for quite some time. And I've been saying that the S&P 500, along with other U.S. stock indices, are still trading in a range, as they have been pretty much for a little over a month. So you can see that range holds true today. And it looks like that rising uptrend line has held as well. And it's very possible that there's some sort of possibly a pennant or triangle forming right now. So I'm just watching this downtrend line and watching this uptrend line. And I want to see if there's going to be a break above or below these key support and resistance levels. But right now I haven't really seen any true signals letting us know if it's going to break out or up or down just yet. So there's been some bad news coming out as far as the U.S. economy. Everything's slowing down dramatically. I don't think it's being priced into the stock market as well as it should. But that hasn't really mattered much in recent years because you have the Fed constantly backing the stock market. So every time there's weak economic data, it tends to be interpreted as a bullish sign. So that's why I just follow the technicals rather than just focusing on fundamentals. So I just like to trade with the trend, really. And that holds even more true since the financial crisis. So that's the S&P 500. Now I'm going to take a look at the Dow. You can see it looks very similar, but I like to follow it still because there are certain key levels in each index that are different, like 18,000, for example, in the Dow. But you can see it looks like it's just coming to a wedge. It's narrowing. And it's really just waiting for some sort of a catalyst. That's usually what happens whenever you see this type of consolidation. It just waits for the next major piece of news, whether it's data coming out of Europe, strong or weak, or maybe news about Bank of Japan's Abenomics easing program, or very often a very strong catalyst will be U.S. economic data that'll probably increase the time frame, or at least push out the time frame for the first Fed fund rate hike. So, and just as far, I'm getting a question from Lori. I don't worry about the tails below the trend line on the S&P 500. Let's go back, and I want to see what you're saying. Let's see. So what I'm really trying to do is I'm trying to make a best fit line. I'm trying to connect as many of the lows as possible. It's more of an art than a science, and as I've said many times, support and resistance levels are usually not a single number or a single line, but rather a zone or a range. So you can see, as far as the uptrend, this is the zone, but also you can see this action has stayed above this support at 2040. So that's how I would incorporate and look at these lower tails. I'm going to be discussing these tails, or they call them wicks in candlestick terminology. We've basically come up with the date for my candlestick workshop. It's going to be April 10th, next Friday. So I'm really excited. That's going to be for Cyber Group members who'll be able to watch for free this in-depth candlestick workshop. And I'm going to be able to, even though I'm going to basically give you in-depth information, I'm going to start out as if you know nothing about technical analysis or candles, and then we'll bring you to the point where you're quite proficient in candlestick analysis. So yes, Lori, it will definitely be recorded as we do with all these workshops. I'm going to be doing workshops with greater regularity for the Cyber Group members, and they'll all be recorded so you can go back, and eventually we're going to build up a big library of these workshops on different technical analysis topics that I'll be teaching. So let's take a look at the NASDAQ 100 right now. You can see same pattern. That, you know, these indices are they're quite correlated, but each one has their own subtle personality and nuances, which is why I look at them. Like, for example, you'll have the NASDAQ 100 tends to be more tech-centric versus, obviously, the Dow. So you can see right over here, it's still in that range, just bouncing up, down, up, down, up, down. Similar to what we saw back this past fall. You can see there was a trading range bounced up and down. I was pointing this out, and once it broke out of that wedge, gave a buy signal for swing traders, and now it appears to be doing the same thing. I don't know which way in advance it's going to break out or break down, but I don't have to, just because I'm going to be waiting for a confirmation in the form of a solid close above resistance or a solid close beneath support. Let's look at the Nikkei really quickly. This is Japan's stock index. I tend to follow it from time to time. It was basically following a channel pattern, and then it broke out in the last few days, and now it's trying to rally and retest that point. It's usually not a good sign, but if it can break back above and go back into the channel, there's a chance it'll continue to follow this channel up. But I'd like to see, let's say in that case, a bullish confirmation from U.S. stock indices, because I want to see these indices basically telling us the same thing. I always look for confirmation. All right, let's take a look at currencies really quickly now. Also, U.S. dollar is also following up that channel pattern. It's just like basically a larger version of that channel that we saw in the Nikkei. Kept on bouncing, 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 and now it's in another consolidation pattern. It pulled back a bit today because of today's weak economic data in the U.S., but really no change in signal. You can see it's still bouncing around between that support right over here. Basically, you can see the lows that formed, I think, a week ago or 2 weeks ago, which are pretty much also the highs that we saw back here in February. And then we have a resistance at the prior highs right over here. So I want to see if it's going to bounce around back and forth and then eventually break above and then keep rallying, or break down and pull back, which could possibly cause non-U.S. currencies and also commodities to rally because they trade inversely with the dollar. Whereas if there's a bullish breakout from this consolidation pattern in the dollar, it's most likely going to punish commodities and non-U.S. currencies. So I'm always watching the U.S. dollar index for cues into non-U.S. currencies and also commodities. And this is the euro versus U.S. dollar. You can see it's been in a downtrend. And I was watching 110 as resistance after its breakdown. So you can see it rallied a bit today. It looks like it's trying to break above that downtrend line, that resistance line. But for additional confirmation, I would want to see it break above 110. It's a major round number. It's also pretty much marks around the highs. But it goes back to the principle of resistance is rarely a single level or a single line. It's usually a zone. So in this case, it looks like the resistance zone in the euro is between 1.10 and 1.11 to the US dollar, because it marked the lows back in January, and also it incorporates pretty much the highs that we saw here in late March. So that's a zone. It's going to need to basically break above all three of these lines in order for there to be a bullish confirmation, at least in my mind. You see this downtrend and the two overhead resistance levels. And then that would be a stronger signal if it could break above there and at least close. Let's look at the dollar yen. You can see it's still pretty much in that wedge. There really has not been a strong catalyst in the overall markets lately to cause them to break out of their consolidations. They're still waiting for something. They're still waiting for maybe a Bank of Japan meeting. Like you can see, this is the dollar yen, and you can see this resistance pretty much here at 122. I want to see if the yen continues to weaken, And let's say if there is a bullish confirmation in the US dollar index, if this currency pair is going to break out of this wedge and continue to rally, similar to what we saw several times over the past few years. You can see this. There was a triangle right over here back in mid-2013. There was another similar pattern that we saw back at the beginning of 2014. So you can see the yen, dollar yen, continues to make these patterns. And the ongoing longer-term trend has been for the yen to drop because Bank of Japan is printing and purposefully trying to weaken their currency to boost exports, and they're trying to pump liquidity into their deflation-prone economy. So that tends to put downward pressure on the yen. And also the fact that so many central banks around the world have been easing has been basically pushing up the US dollar and weakening these non-US currencies and also commodities. Let's look at the dollar Canadian. Same thing over here. I'm just watching this consolidation pattern. Just want to see how this is going to resolve. I don't know in advance. I don't even try to predict which way they're going to break out or break down. I just know when I tend to see consolidation pattern like this, it tends to lead to further moves once there's a final breakout. So I'll be watching this. And if there is a solid breakout in the dollar index, and let's say there's further commodity weakness that hurts the Canadian dollar, then I wouldn't be surprised to see the dollar Canadian finally break out of this. The resistance is at 1.28. That's the number I'm watching. On the other hand, if it has a breakdown, then I'm willing to go with that too. For me, I follow support and resistance and make sure that multiple correlated markets are confirming one another. I don't even try to forecast or do anything like that. So let's take a look. I just want to see gold really quickly. So here's what I've been watching in gold. You can see it was in this downtrend channel. I was showing it as it was following that channel down. It finally broke out of that channel, and it bounced off that support, which was pretty much the October-November lows, right around 11.50. So it bounced from there because the dollar pulled back, thanks to Janet Yellen's comments. So now I'm watching to see what's next for gold. I'm not seeing a clear trend just yet. It's been struggling to break that key psychological level of 1,200. But right now it looks like it's consolidating. It's probably going to bounce around for a bit until it finally continues on. Maybe it could be an uptrend if there's, let's say if the dollar were to pull back and there was a technical breakdown below those key trend lines that I showed you in the US dollar index, then that would probably be bullish for gold. On the other hand, if the dollar index experiences a bullish breakout, then I wouldn't be surprised to see gold retest these lows right around 11.50. So my last market will be gold, and then Jim Romelli will go on. So here we go. This is West Texas Intermediate crude oil. It's still in that range between $54 per barrel and $44 per barrel. I don't expect any significant moves until one of these key levels is broken. Until then, you're just going to get this type of chop and slop that we've seen for the last 2-3 months, and everyone's guessing which way is it going to head. A lot of it depends on the dollar. If there's a bullish dollar move, then I wouldn't be surprised to see oil continue to drop. But if the dollar does break down, then that would reinforce the case that there was a bottom in oil. So I'll be watching this very closely. All right, so I'm going to take a pause, and then Jim Romelli of Keene on the Markets will begin at 4:30. Fausto will introduce him, so I'm looking forward to this presentation. Take care, folks. Hello, ladies and gentlemen. It's Jesse Colombo from Cyber Trading University, and I'm very excited to have James Romelli from Keene on the Markets today. He's giving us a very fascinating presentation called Using Credit and Debit Spreads to Trade Earnings. And he's going to be teaching how to basically read and use measured moves to find price targets. And he's going to be explaining some of his favorite setups for when he trades company earnings reports, as well as the types of catalysts, basically the type of events and catalysts that offer tremendous opportunities with low risk and high reward. And he specializes in weekly options. So
Thank
definitely
you
looking
very,
forward
very
to
much
this.
for the introduction.
Thank you so much, James. And
I am going
start
to
when you were ready.
share my screen here with you guys for this presentation. So we are going to be talking about trading earnings, and specifically what we're going to be talking about is how I trade earnings and the specific plan that I use to take different types of earnings trades. So just very, very quickly, before we jump into the full presentation here, how many of you out there have ever heard someone say, you know, be an educator or maybe read it in a book, heard it from someone on financial TV, saying that you should never, ever trade a stock ahead of earnings because it's too risky? Has anyone ever heard that? Yes, yes, yes. Okay, so a lot of people are of that mindset. Believe it or not, I actually 100% agree with that statement. I would never, ever, ever trade a stock ahead of earnings because it is too risky. I want to take trades on earnings because movement creates opportunity, and earnings and the uncertainty that surrounds earnings creates a lot of unexpected or larger than normal moves in underlying stocks. So there is opportunity to profit there. But I agree with the idea that I should never ever take that position with stocks. So we're going to talk about how I use weekly options to take these types of views in stocks ahead of earnings with much less risk and a very high level of reward. And I'm going to show you all about how I determine what stocks are going to be my favorite ones to play, how I determine what strategies I'm going to use, and how I know when I'm getting a good risk versus reward setup or a high probability setup. So let's jump right in here. So before we get started here, I do have our standard boilerplate risk disclaimer. Day trading, short-term trading, options trading, and futures trading are extremely risky undertakings. They generally are not appropriate for someone with limited capital, little or no trading experience, and or a low tolerance for risk. Never execute a trade unless you can't afford to and are prepared to lose your entire investment. All trading operations involve serious risks, and you can lose your entire investment. No trades or recommendations or advice, and we cannot be sued for losses of capital. All trades are for educational purposes only. Contact your broker or RIA for execution margin and other capital requirements. Everyone watching the presentation adheres to all disclaimers on optionhacker.com and KeeneOnTheMarket.com. So I've read that once or twice in my time, but I'm not going to spend too much time talking about myself, and I will get to your question in just one second. But thank you to Jesse for the great intro. But my name is James Ramelli. I'm an active trader here at KeeneOnTheMarket.com. I moderate our live trading room along with our three other moderators. I trade futures, forex, stocks, commodities, but 95% of all my trades are going to be in equity options. I'm regularly on CNBC, Bloomberg, Fox Business, BNN Canada. I was on CNBC yesterday to break down the GoDaddy IPO and what I thought about that. And if you haven't seen me on TV, maybe you've read something that I've written. I read for Futures Magazine, Active Trader, Resource Investor, CME Open Markets Magazine. So maybe you've heard of me, maybe you've seen me on TV, maybe you've read something I've written. But to answer your question there, Michael, and before we get started with the actual, you saw me yesterday on CNBC? How did I sound? I'm trying out this new beard that I grew here. That was the TV debut of that beard. I think it went relatively well. But as we go through this, please feel free to handsome. Wow, you're my new favorite person in this webinar. As we go through this, please feel free to interrupt me with any questions that you have, because with the number of people that are in here right now, I guarantee you that if one person has a question, there's a dozen other people with the same question who either are too afraid to ask about it or just won't ask for whatever reason. So let's talk about earnings. What are quarterly earnings, and why is this the perfect time to learn how to trade earnings properly? Well, it's a really great time to learn how to trade earnings properly, or at least to think about how I go about trading earnings, because there is a new cycle about to start next week. Wednesday, Alcoa reports after the bell. That's the 8th. And that's kind of the unofficial start to the next earnings cycle. It's not really the official start to the cycle, but that's basically when the new cycle starts to kick off, okay? So pretty soon, day in and day out, we're going to have hundreds, dozens or hundreds of companies reporting earnings every single day. And what's really, really great about trading earnings is that there's so many releases in a given day once we get into the swing of the cycle that I only need to focus on the top plays or the best possible setup. So let's say that I have 10 factors that I consider for a setup. I don't need to take any of the trades that only have 9 of them. I can hone in on my highest probability setups and be the most selective during earnings season because there's so many different trades. If I don't like any trades today, guess what? There's going to be 10 new ones tomorrow that I can consider and take a look at. But publicly traded companies release their earnings every single quarter. They announce their revenues, earnings per share, and they also provide guidance for the future earnings. Analysts spend a lot of time trying to determine what the company's earnings are going to be, and they have an estimate. And then the market will react based on what the earnings are, what the revenue is, what they are compared to estimates, and of course what they guide forward to the next quarter, and what all of the executives have to say in the conference call. But earnings are very important in a stock's price because earnings, the forward earnings, is what determines what a stock's price should be, right? They affect PE ratios, okay? Because what is the value of a stock? Really, academically, it's a discounted value of its future cash flows, right? And that's what forward earnings are, okay? So earnings create some very, very wild swings in price. And a whole bunch of you, probably about 15 people, said that they've heard people say before, hey, you should never trade earnings, never put on a trade in a stock ahead of earnings. And it's because they get afraid of these types of wild moves in price. Okay, now believe it or not, because this is a common misconception about options, I can use options to actually risk less and make more than I could with the stock. Trading stock ahead of earnings is incredibly dangerous. Very, very risky. I would never want to be short stock ahead of earnings. I would never want to be long stock ahead of earnings. Okay, we see huge moves on earnings, gaps. Okay, so why do I want to trade earnings then? If all of those things, seem like perhaps they make it more risky, or that I have to put a lot more cash on the table, or I'm going to be kept up at night thinking about where the stock's going to gap once the conference call starts, why would I even want to bother trading earnings? Well, the wild swings in the stock's price create opportunities for traders to profit. These movements expose you to a large amount of risk if you're not careful. So it's really important to use option strategies that have limited amounts of risk. And we're going to talk about a bunch of different strategies that I can use to take small amounts of risk and profit many more times my risk in just a few days using these types of spreads. So one of the things that someone asked at the very beginning was, what if you trade a strangle? And I wanted to wait until we got into this because that is probably my least favorite type of earning strategy. Other than just buying or shorting selling the stock naked, trading a strangle or a straddle ahead of earnings is probably my least favorite strategy. I can't remember the last time I did it. I'm sure I have at least once in my career, but I can't remember the last time I did it because 99.9 times out of 100, it's not going to set up well. Okay? Because that falls into one of the common rookie oversights that beginner traders fall into once they first start trading earnings and don't quite understand some of the special dynamics and considerations that you have to make ahead of earnings. So what do we know about earnings? We know that the stock's going to gap up or down, okay? It's not always going to gap up or down, but more often than not, the stock gaps, okay? Some stocks, on average, gap 5% on earnings. Some gap more. Some gap 15%, okay? So it's a huge move in price very quickly, and we know that that can create opportunities. So Michael says, a strangle you can't lose on both sides. You absolutely can lose on both sides. Okay? If the stock does not move enough, I can lose money on both sides very easily. Okay? It happens all the time. And I'll show you guys an example of that at the end of the day today, or a trade that actually happened today, and how the strangle buyers got absolutely crushed. Okay? Because that brings us to the next 2 points here. They don't understand the drop in implied volatility that options markets experience post-earnings, and they end up getting long too much premium ahead of earnings. That would be buying a strangle or buying a straddle. So earnings creates a point of uncertainty, okay? If the market is working like it should and everyone is obeying the rules and behaving themselves, nobody that could actually go out and trade on it knows what the earnings are going to be, okay? Obviously sometimes, can be situations where the earnings might be pre-announced or they leak or someone has material information that is trading on it when they shouldn't be. But the vast majority of the time, nobody knows what they are. So it creates this point of uncertainty, okay? And uncertainty creates more implied volatility because we know that the earnings are going to move the stock a lot. So then we have a lot of hedgers coming in, short stock sellers buy upside calls to protect their short stock position. People that are long the stock buy downside puts to protect their long stock position. Speculators, bullish speculators buy out of the money calls and bullish positions to get long. Bearish speculators get short via puts or other bearish options positions. But all of this creates an increased demand for options. And implied volatility isn't just projected moves. It's also showing me what the supply and demand curve for options is going to look like. Okay, so my Vega, yeah, right, Vega is very high. Volatility is very high. Once that uncertainty is gone, and we know it's going to be gone, right, because they're going to come out with earnings, right? If I'm looking at implied vol today in a stock that has earnings after the bell, well, I know that tomorrow that uncertainty is gone. We know what the earnings are, right? And implied vol drops. All right, so being long too much premium ahead of earnings can really be dangerous for a trader who doesn't quite understand that implied volatility is going to drop a lot after earnings, okay? Also, bad risk versus reward setups. Long stock and short stock are always 100% of the time going to provide a bad risk versus reward setup ahead of earnings, okay? And poor chart analysis is another thing that really trips traders up ahead of earnings. Right, theta does work in your favor if you sell options, but I'm going to talk about the special situations or different situations where being short premium is especially high probability or profitable there. Yeah. So let's take a look here. So historical versus implied volatility. An understanding of historical versus implied volatility is extremely important to trading earnings because before I develop my targets, I have to understand what the historical versus implied vol is telling me, okay? Each one by itself doesn't really give me that much information. Once I can have a basis of comparison, I can compare the two, well, that's when I am able to look at a piece of information that then tells me something that I can then use to help develop targets and hone in on a strategy. So historical volatility measures realized fluctuations in the stock price, shows when there were sharp movements in price, and it's calculated by looking at past price changes. So when I talk about historical volatility for earnings, what I'm looking at is the past movements on earnings day that the stock has seen, okay? And then I compare that to implied volatility. That's an estimate of the volatility in price, all right? So market makers will price in a move that they are expecting ahead of the earnings. And if I know what to look for in the options market, I can determine what that expected move is. Once I know what that expected move is, I can compare it to past moves and then start to develop price targets. We always see volatility rise going into events like earnings, drug announcements, new product launches. It's a key component of options pricing. Okay, if you take nothing else away from this presentation, you see all of this and you say, hey, I still don't really want to trade earnings. This is one thing that you should take away from this and understand well, because you can use these type of implied volatility and historical volatility comparisons to develop better targets when trading something like the iPhone launch or a drug announcement or unemployment, any type of catalyst event. Okay? So here's an example, and these are real options prices. And I just wanted to show you about how the options market responded here to an event. We had some Apple calls ahead of earnings, right? And this was last year on earnings. But these calls were the 100 strike calls, and they were trading at 45 cents ahead of earnings. The next day, Apple rallied by over 3% or nearly 3%, but the calls were trading at 8 cents. Okay? They lost 80% of their value when the stock rallied 3%. How is this possible? Implied volatility. All the implied vol came out after the earnings were announced. The uncertainty is gone. All of the options premium disappears. Okay? When I'm buying straddles and strangles ahead of earnings, this is my worst fear, right? And this happens a lot more often than you might think it would. Implied volatility can just be a huge drag on the position, even if the stock is going in the right direction. And trust me, there's nothing more frustrating than being right directionally and then losing money being long. Right? I mean, I don't want to have an idea or thesis behind a trade saying, I think this stock is moving higher, I'm going to put on a trade, and then have the stock move higher and I still lose money. Okay, that's incredibly frustrating, but it's something that I can help avoid by looking away from strategies that are all outright long premium, like straddles, strangles, long calls, and long puts. Okay, so before we jump into actual strategies, I have to determine what stocks I'm actually going to want to play on earnings. So when I pick a stock that I'm going to play for earnings, the first thing that I want to see, and I actually don't think it's on here, but the first thing that I want to see is a stock that has options, okay? If it doesn't have options, I'm not going to trade it on earnings, because then I would be forced to take a trade in the underlying stock, and I never want to trade underlying stock ahead of earnings, okay? Secondly, I want it to have weekly options. Now, it doesn't necessarily mean that I'm never going to take a trade in a stock that doesn't have weekly options, but 9 times out of 10, I'm going to take a look at 9 times out of 10, I'm going to look at a stock that doesn't have weekly options and pass and say I'll find something else to trade. Okay, why is that? Well, weekly options help me most effectively isolate the catalyst event of earnings, and weekly options also let me take the trade with a smaller amount of premium, right? If I have an option in a stock that is reporting earnings on a Monday, and I can trade the options that expire Friday or the options that expire in 3 weeks, which ones are going to be quote-unquote cheaper for me to trade? Which ones are going to have less premium? I'm going to lay out less money to get into the trade. Well, the weekly options, right? Because time premium is a big part of options. Yeah, the ones that expire this week, the front month options. So it's kind of a really good reason to want to take those front month options is because, one, they most effectively isolate the catalyst event, and two, they're going to be the cheapest options. Okay. I also want options that are very liquid and the ones that do not have extremely wide markets, because then I know it's going to be really difficult for me to get out of my position according to my trading plan. And we're going to go through the trading plan step by step with a couple of different examples here once we get into this. No, we're talking about earnings today. So someone says, what if the call option is at the money when you buy before earnings and the stock moves up? Implied volatility shouldn't be so decisive. Well, it depends, Eric. So think about this. Let's say that the market makers are expecting a $5 move in the stock, right? So they price the at-the-money calls accordingly, right? Let's say that the at-the-money calls are trading around $3, okay? Well, what happens if the stock does not move its full implied move? What if the stock only moves $2? Well, then I've lost money, and all of that premium, that extra premium that was in those options, is going to disappear right away. Okay, and I can actually take a big loss even if the stock moves higher. Okay, does that make sense? Implied volatility is going to be jacked up across the board, right? In the money, out of the, out of the money, in the money, at the money options. So if I can take a trade, and I'm going to show you some different strategies that you can do. If I can take a trade that lowers my exposure to that implied volatility, I'm going to do that every time. I rarely just trade outright options. No, I don't really look at a stock's average true range, okay? Because average true range really kind of loses all of its meaning on earnings because it's kind of an outlier catalyst event, right? It's not something that is, another day in the life of Apple as a stock, right? It's something that it should be viewed separately. And that's what we're going to talk about, too, is isolating the catalyst event. Okay, so my favorite earnings to play are popular, widely held, intensely followed stocks that are going to have a psychological effect by the announcement, meaning there's going to be a lot of people rushing to put positions on or exit positions based on the earnings, okay? Ones that I know are going to move, okay? So, we have a trading plan. We have a trading plan that we have written for trading earnings, and it is a 7-step trading plan here. We call it the HIM-CRIBIT trading plan. I know that's not the most elegant way to say the name of a trading plan. It's not the most elegant acronym, but if you have any other suggestions, we're more than happy to hear it. But it's a systematic approach to catalyst trading. So anytime that I take an earnings trade, regardless of the stock, regardless of the industry, regardless of the sector, I am looking at it the same way every time using this trading plan. Okay, and the letters in the acronym stand for historical movement, implied volatility, measured move targets, chart, risk, reward, break even, time, and target. Okay, all of these things are equally important to taking a good earnings trade. I have to consider every single one of these factors. If there's anything I don't really like about any of the factors in the plan for a particular stock, well, then I can take a different trade. Implied volatility, implied movement, we kind of use the two interchangeably. What about open interest and volume? So for earnings, again, open interest and volume is not really going to be something that is going to be that important for me. Okay? Because there's too many differing opinions. I can't just look at a line of puts or calls ahead of earnings and say, oh, well, look, there's a lot of open interest there. I think they're probably going to pin the stock there. Doesn't work that way. There's too many differing opinions to read into options order flow ahead of earnings, because there's hedgers and speculators who are both very, very interested in taking options positions in that stock ahead of the report. Okay? So the order flow and the ticker tape can get very noisy and very cloudy ahead of earnings, with all of those differing opinions, hedgers, speculators, all jumping in and putting on positions at once. Okay, does that make sense? Then that's kind of what causes the increases in implied volatility anyway. So how do we break this down? So I have a couple of examples here, but the main focus of the plan. The main focus of the plan is to guide me into strategies like this, okay? And I have them listed here, and this is probably listed in the order that I most frequently use them. But my favorite types of strategies to trade ahead of earnings are call and put spreads, call and put verticals, call and put butterflies, condors, iron condors and iron butterflies, calendars, and that's pretty much about it ahead of earnings. I'm really not going to trade any other strategies. And, the top 3 of them are probably going to be my most commonly traded strategies. Iron condors and iron butterflies probably sit, just above condors and call and put condors. But these are going to be my main, my main toolbox for trading earnings. Call and put verticals. What is a call vertical? A call vertical is buying one call and selling another against it, or selling a call and buying a further out of the money call against it. Same thing for a put vertical. Okay, but as you can see, all of these trades are spreads. Every single one of these trades are spreads. There's no outright option strategies here. So when I am long options and then short options against those long options, I am helping to negate the drop in implied volatility that I know is going to happen after earnings, okay? This is why straddles and strangles are not going to be on this list, is because there's nothing there to help me, to protect me from the drop in implied volatility if I'm wrong, or if the stock doesn't move. Yes, an iron condor is a combination of a call and put vertical. An iron butterfly is also a combination of a call and put vertical. By catching some premium in front. Okay, so here, and I'll go through more examples of this in a second here, but let's take a look and run a stock through the plan here. And this was ANF this past earnings, when they passed report from ANF, which was just at the end of February. And I actually took this trade, and it was very profitable for me. So ANF was trading around $24.20 going into earnings. Okay. I can go back and look over the past 8 quarters and see that ANF, Abercrombie & Fitch, sold off 5 times and rallied 3 times in the past 8 quarters. So I know that for whatever reason, over the past 8 quarters, there has been a bias to the downside in ANF. Okay, these types of trends on earnings are important to note because a lot of times you'll start to notice that, hey, it doesn't really seem to matter what the actual earnings are. Stock XYZ seems to sell off every single time. It doesn't really seem to matter if they beat, miss, or absolutely blow estimates out of the water. Well, what can happen in certain situations with stocks that don't have good analyst communities, stocks that are not well covered, a lot of times expectations can be a little too high or a little too low, and you notice these types of trends. But I know that over the past 8 quarters, investors have just not been liking what they have seen from ANF earnings. The average earnings day move over those 8 quarters was 6.9%. Okay, so automatically I have the expectation that is 8 quarters my key number. Yes, 8 quarters is what I look at. Actually, now that we had to develop something ourselves to look at more data, but we're going to get to that in a little bit. But yeah, 8 quarters is the bare minimum amount of data that I want to look at to develop, to try and pick out a historical earnings trend. Okay. So then, in order to calculate what my implied move is, I need to look at the at-the-money straddle or at-the-money strangle. If a stock is trading right on the strike price, I can use the at-the-money straddle. If it's in between strikes, I need to use a strangle. So the price of the weekly 24-25 half strangle was around $3. Okay, $3 into 24.20, that implies a move of around 12.4%. Okay, so that tells me 2 things. 1, market makers are expecting the stock, options market makers are expecting the stock to move $3 higher or lower by this expiration, which was that Friday in weekly options. Okay. Also, they're telling me that they're expecting it to move a lot more this time than it normally does. Okay. Both of those things are important points to note. Okay. But then, once I know what this implied move is, I can use that to calculate my measured move targets. All right? So, using that strangle price, which was priced around $3, and the stock trading at 24.20, yeah, absolutely. I never trade them. I'm using the price of the straddle to determine a target. I'm not trading a straddle or a strangle. I'm using the price of the strangle. So I see the strangle trading at $3. That tells me that the market maker is implying a $3 move in the stock. Okay, I'm not. But then what I'm going to do is take that $3, add it to the stock price, and subtract it to the stock price to get my measured move targets. These 2 targets are going to be the implied closes for the stock on Friday expiration. This is where the market makers are saying the stock can be on Friday. Is that a little bit clearer now, Byron? Because this is an extremely important point to understand for this earnings trading plan. This is the implied move for the stock. Okay, does that make sense, so Byron? Is anyone not understanding how I'm calculating this implied move and determining these price targets? Is anyone not understanding that? If so, then I'd like to go over it again. If not, we're going to move on. Okay, sure thing. So, if I have a stock trading at 24.20, like ANF, I'm going to look at the straddle or the strangle. If the stock is right on a strike, which in this case it's not, it's in between strikes, I need to use the strangle. So the 24-25 half strangle is $3. That means that the market makers are implying a $3 move higher or lower by this expiration. Okay, I can then use that to determine that they're implying a 12.4% move. That is how I calculate my targets. Once I have that number calculated, that $3 move that I see they're pricing into the market, I can add that to the stock price to get my upside target and subtract it from the stock price to get my downside target. So once I have those levels in mind, that takes care of the measured move target part of the trading plan. Then I need to look at those levels and compare them to the chart of ANF. Okay. So I'm only going to use one indicator to trade this earnings trading plan, and it's going to be the Ichimoku Cloud. So who here has never heard of the Ichimoku Cloud? Has never heard of it, never once used it? Has anyone just never heard of it before? So at least one person. Never? Okay. Right, you have to look at the options change to calculate the straddle price or strangle price. Right, so I'm looking at the options chain to make that calculation. So, yeah, if the price is in between strikes, I use a strangle. If it's right on a strike, then I use the straddle. Okay. So an example there for Abercrombie, if the stock was right on 24 or right on 24.5, then I would use that straddle. But since it's in between them and about halfway in between them, I need to use a strangle. Okay. So the next slide shows a chart of Abercrombie & Fitch ahead of their that most recent earnings released on the Ichimoku Cloud. The Ichimoku Cloud is one of the easiest indicators to use. It helps me identify overall trend, confirm trend on multiple time frames, and helps me spot key levels of support and resistance and rule out the weaker setups. Okay, so this is what the Ichimoku Cloud looks like. All right, if you take one more thing away from this presentation, take away this. Anything that's trading above the Ichimoku Cloud is in bullish territory. Anything trading below it is in bearish territory. I can spend 4 hours, and we have some workshops on the Ichimoku Cloud that are over 3 hours long. I can spend that much time talking about all the finer points of what we're looking at here and all the minutia of each one of these components. I'm not going to do that because for trading earnings, really all I want to be able to do, I'm talking about credit spreads and debit spreads. We're going to get to more of that in a second. So all I really want to be able to do for this type of trading plan is the trend, according to the Ichimoku Cloud, is going to count as a point in the bearish or bullish column in the trading plan and help me make my final determination. Here we can see that the shaded area here is very much downward sloping. ANF is very much below this area, and therefore very much trading in bearish territory. Okay, so once I know that the stock has sold off 5 of the past 8 quarters, it's bearish on the chart, I pretty much know that I'm going to want to be getting short this name, right? I pretty much know that I'm going to want to be getting short. So the chart is in a bearish pattern. The historical movement, it has an extremely strong bearish bias. What charting service you use to obtain the Ichimoku Cloud? Oh, you can get the Ichimoku Cloud with pretty much every major retail broker, Ameritrade, Interactive Brokers, eSignal has it, TradeStation has it, and if you don't have access to any of those, you can go ahead to TradingView.com and get it on there. And I believe it's like $20 a month for TradingView.com. It's a premium service to get extended data. You buy it or not, we have no relationship with them. I use it all the time, but that's the best place I think for the free Ichimoku Cloud. Also, freestockcharts.com has it as well. That's what I was just about to mention. So once I see, I don't believe Options House does. Oh, actually, they do now. They do now because Trade Monster has the Ichimoku Cloud. You're right. Yes, you're right about that. Exactly. Actually, funny story. Trade Monster did not have the Ichimoku Cloud until we at Keene on the Market told them that they needed to develop it for their platform because we were doing webinars for them about the cloud and they didn't have it. But so what did I do here in ANF? I knew that the chart was bearish. I knew that the historical movement had a very bearish bias. So I knew I wanted to be short. Okay? I calculated my downside target back here of 2120. Okay? So my downside target is 2120. I know that I want my strategy to center around that 2120 downside target. Okay? So what I looked at here was the ANF March 6th weekly 22 half 21 put spreads for 45 cents. Okay? I could risk $45 per one lot here to make $105 per one lot if the stock was below $21 on expiration. Okay, and I had a break even of 22.05. So as you can see, basically when I'm doing a debit spread, I'm always looking to sell the strike where I think the stock can go. Why is that? Because below 21, I no longer participate in downside in this. So why would I want to be more aggressive than that? I just want to hit the target of 21.20, right? I think it could probably move a little bit more. I try to get as close as possible. But for this, I'm getting a really great risk versus reward setup on my money here. I'm risking 45 to make 105, right? And that's better than 2 to 1 on my money. Okay, that's better than 2 to 1. That takes care of the risk, reward, and break-even steps of the trading plan. Like I said, this offers me a fantastic risk versus reward setup here. So someone says, please explain the order here. Yeah, absolutely. So this weekly 22 half 21 put spread, very simple spread to put on. I'm buying the 22 half puts and I am selling the 21 puts. Okay. So this was the March 6th weekly options. That was the option line that I traded. The March 6th weeklies. So they expired the first week of March. So explain 105, right? So the most that this spread can be worth is the difference between the strikes, which is $1.50. Okay, $1.50 minus the 45 cents I paid for it is $1.05. So if this goes to maximum value, the most I can make is $105. $1.05 or $105 per one lot. Yeah, absolutely. Okay. So this is what happened on earnings. The stock gapped lower on earnings. It sold off again the next day, and you can see it here trading at 19.55. So at 19.55, this spread would go into maximum value. Why did I not use credit spreads? Well, for one, a credit spread 9 times out of 10 is going to offer me a worse risk versus reward setup than a debit spread is. Okay, because let's say I sold at the money call spreads in this. Maybe I could sell those spreads a dollar wide spread for 30 cents. So my risk on that is 70 cents. So instead of getting 2 to 1 odds on my money, I'm now risking 70 cents to make 30 cents, right? I typically want the risk and reward to be the other way around, right? I want to make more. I want to risk less and make more, not the other way around, right? Not risk more to make less. Okay. So time and target. So these options expired at the end of the week. I knew that. The stock gapped lower that morning, and I was able to take off half of the spread at 90 cents and sold the second half for $1.47, which is just 3 pennies below maximum value. I always have my targets picked before the trade is actually executed. It makes it a lot easier for me to manage it once I have it on. Once we are at a right, I can close it at a small debit if it goes that way. But if the stock moves against me, so let's say I look at the two different trades. In this put spread, I risk 45 cents to make $1.05, right? $1.05. Let's say I sold a call spread again. Sold a call spread with the same risk reward, selling it for 45 with a chance to lose 105. Well, if the stock goes higher, I lose 105 on the short call spread. But if I would have just had the put spread on, I only would have lost 45 cents. That's what I'm saying. They always have a smaller risk reward to risk ratio for a credit spread. Okay. So this trade went for well more than a triple over the course of the week, right? I always take off half of the spread at a double in order to lock in some profits and basically keep the rest of the trade on with house money, right? I have those targets determined ahead of time, and I run through this trading plan every single time I do any type of earnings trade in the live trading room. What account size is needed? We have people in our trading room that trade, with accounts as small as $5,000, and some that trade with accounts, north of $1 million. So pretty much anyone can take advantage of these types of strategies. So it's something that's really scalable, right? And what's really nice about it is that because of the nature of earnings, it's never going to be a day trade. So even if I don't have $25,000 in my account, I can take these types of trades because I'm always going to hold them overnight, right? So that is the trading plan. And I want to run through one more example here using a new piece of software that we have just released this Tuesday called Earnings Hacker, okay? Called Earnings Hacker. So Earnings Hacker is something that we developed to make earnings trading 1,000 times easier for traders. There is so much information that you would have to sift through on a daily basis when we're in the middle of the earnings cycle to pick out the top plays for the day, okay? But Earnings Hacker puts all this information in one place in an easy-to-read way for you guys, okay? So all of the data that a trader needs ahead of an earnings announcement is now available through Earnings Hacker. It's the most comprehensive source for pre-earnings data with implied moves calculated every 60 seconds, so I know that all the data is up to date. Okay, I wait as long as possible, Burn. So if they report earnings after the bell today, I'm looking at like 2:30, a half an hour before the market closes to put that trade on. Okay, so this is what Earnings Hacker looks like. As you can see here, it has all of the information in one place for you guys. Shows the daily Ichimoku cloud. Has 3 different sets of historical data going back 12 quarters. We're going to talk about why that's important. To look at more data and these 3 different sets. And it also does this. It ranks out the top stocks in play for that day based on a set of algorithms and proprietary data that we use to determine what stocks are going to present the best potential opportunities. So no need to scour the internet for all this data anymore. Earnings Hacker has all of the data you need to make informed earnings trades. EPS estimates, analyst ratings, revenue estimates, all of that is right here. You can see for Monsanto ahead of their most recent earnings report, all of that data was here. And if you're not so sure about how to calculate that market, that measured move target or that implied move, we have that here calculated for you. And it's updated every 60 seconds, so you know that it is up to date, all right? The expected move on earnings in the underlying stock calculated using the options market is always there for you, and it helps you pick your targets for earnings trades and produce better results. Also, it shows me all of the estimates for earnings. It shows me all of the analyst buy, sell, and hold ratings. So if you're a trader that likes to look at a little bit more fundamental data, all of that is there for you as well. See the consensus guidance for the underlying name. All of that information is now in one place. I know that before we had this, I use this every single day now. Before we had this, I would have to scour the internet for 25 minutes to find all of this information in one place, or I'd have to look in 4 different places to find all of this information before I went on CNBC to talk about a stock ahead of earnings. Okay, but this is what really makes Earnings Hacker interesting and unique is our ranking systems. So Earnings Hacker Rank is a simple, very easy to read ranking that determines whether or not a stock looks bullish, bearish, or neutral ahead of earnings, okay? A trader can use that data to hone in on the best possible setups and avoid buying too much premium ahead of earnings. If an Earnings Hacker rank is telling me that a stock's going to be neutral, well then I know that I don't really want to be buying too much premium because they're saying that, hey, because the historical data looks like this, because the chart looks like this, and because the options market looks like this, we are now determining that this is a neutral setup, okay? The chart rank is another Earnings Hacker exclusive metric. You can't find this anywhere else. It automatically determines how strong the chart is. The ranks go from -6 to +6, and for any of you who know about the Ichimoku cloud, you know there's 6 components, so those numbers have some meaning there. With a rating of -5.66, we can see that Monsanto is in very bearish territory on a chart. So if I don't know how to read the cloud or I don't have the cloud, it doesn't really matter. Earnings Hacker reads the cloud for me. Okay? Trade rank. This is hands down the most important feature and the most beneficial feature in Earnings Hacker. This is another exclusive metric, and it helps a trader sort through dozens of symbols in a day to find the best stocks. As we were developing this and I was working with our developers, we noticed that on a really busy day in the earnings season, there might be 120 to 140 stocks that report, okay? Of those 120 and 140 that report, not all of them are going to have options, but it's still dozens of stocks that I would have to go through. Now, do I really want to go through that 7-step trading plan for every single stock when there's 40 stocks that are reporting in the day or 50 stocks that are reporting? No. I want to know right away which ones are setting up for the best risk versus reward setups. So TradeRank is calculated that using an algorithm that we've developed that takes into account historical moves, implied moves, technical analysis, options data, and risk versus reward to determine which stocks are, quote unquote, providing me the juiciest setups. Okay. Earnings Hacker automatically sorts every symbol by trade rank, showing you which stocks have the best risk versus reward setups on a given day. Filters out all of the noise. I don't have to worry about, trading stocks that are not going to be the best type of setups. What is the range for trade rank? Trade rank is an unbounded ranking, right? So it's all relative to what type of, so it also considers options liquidity, right? There's not going to be any highly ranked, trade ranked stocks that don't have weeklies or have weeklies that don't trade, okay? We take into account all of this, all right? But this is also something that you're not going to find anywhere else, and it's comprehensive historical data sets. Earnings Hacker has 3 sets of historical data movement data across 3 time frames. So one of the things that people ask me all the time is like, hey, I understand how to set up the earnings trade, but once the move happens, I never really know how to manage it, okay? Well, this is what we've designed to help traders manage their earnings trades better. Okay, so we see here we have data for movement on the day of earnings, movement the day after earnings, and movement to the closest expiration, okay? So I can look at this and determine and see trends. I can see, hey, it looks like this stock usually rallies on earnings, but then sells off and fades into expiration, okay? It helps me manage my positions better. If I notice that a stock pops on earnings, I'm long, but I see that in the historical data, it typically fades into expiration, well, then I know that I should probably take my profits now. Likewise, if I look at a stock that I'm long ahead of earnings, stock pops on earnings, and then I look at this data and I say, hey, it actually looks like it continues to rally into expiration 8 out of 12 times. Well, now I probably want to hold my position a little bit longer and try and squeeze more out of it, right? So seeing these trends and determining what trades are the highest probability setups really helps me manage both entries and exits. It helps me squeeze the most out of every single trade. Okay? All of this I can use to take positions overnight ahead of earnings. I can determine the best time to close, open, hold, or add to a position, the optimal time to exit and enter. Yes, the higher value for a trade rank implies a better setup. Yes, absolutely. So, Earnings Hacker also generates trade ideas. So when a certain predetermined risk versus reward condition is met, Earnings Hacker generates a trading idea. These ideas are only generated when that risk versus reward condition is present, and a trader can then use this idea to make their own informed trade decision, okay? When there is no trade idea generated, it means that there may not be a suitable trade or a suitable risk versus reward setup available at the time. Trade ideas take into account trade rank and chart rank, along with a number of other metrics to make sure that it's only going to show up if it has the best looking setup, okay? So we also very easily display the top 5 trades for a given day, top 5 trade ranked trades. So you can see that going into Wednesday, because we are at the end of the cycle, Monsanto was the only one. All these other stocks were either very cheap, you can see some penny stocks trading here, or did not have weekly options or option strikes that were beneficial or helpful for trading earnings. Okay, it helps me avoid the weaker setups and hone in on the highest probability plays, because I can't tell you how many times that I go through an earnings day when we're in the middle of the cycle and I see a stock that has moved on earnings that I just missed somehow or overlooked because I was looking at so many other things and wasting time trying to filter out all of the noise and bad setups. Okay? So, Monsanto runs through the exact same trading plan, and look how much faster I can do this using Earnings Hacker. Over 12 quarters, I can see that it's neutral, rallied 6 times, sold off 6 times, average move of 2.2%. I can see that they're implying $3.43 this time, right? This cuts my time like in half. I can use that move to calculate my measured move targets and then take a look at the chart, again using the cloud. Monsanto bearish on the daily, that's why it has such a weak Earnings Hacker chart rank. And then I can use that to determine a trade here. Here they Earnings Hacker spit out this iron butterfly for a 217 net credit. I was able to tweak that a little bit and get a little bit better risk versus reward setup. Now the stock ended up moving higher and this trade did not work out, but I'm able to use this information to create a better, more informed trading decision. Earnings Hacker told me here that implied volatility was too high and that I might consider getting short. That is what I ended up doing. And Monsanto had a big surprise quarter. Okay, so it doesn't always work out, but it got me into the best possible reward to risk setup that I could get. I couldn't be happier with the trade that I put on, right? I was risking $3. I was risking $90 to make $310 and was short premium. I love that type of setup ahead of earnings, okay? And Earnings Hacker guided me into that trade incredibly quickly, okay? Again, these options expired today. I target them the same way. Hacker helped me plan through every single step of that trading plan extremely quickly and extremely efficiently. And it told me that Monsanto was going to be the one that I wanted to focus on the most. Okay, so with that, before I take questions, because I know you guys have a lot of questions, I want to tell you a little bit about what some of our customers have said about earnings trading and Earnings Hacker. I've been killing it with your techniques trading earnings and measure move targets, up 25 grand just this week. I was trading fives, now I'm trading 50s and hundreds. I was afraid to enter earnings trades, but now I look for them because I have learned how to trade different strategies, so thank you, Team KOTM. I have a lot of courage now to trade emotionless and take decisions faster. Frank says, due to the well-articulated educational material, I've quickly learned about Greeks, spreads, and using options to grow an account and maximize return on investment. Without KOTM and its excellent options education course, I would still be floundering as a trader, but because of this excellent presentation and a vast array of information, I've been able to break through as a trader and finally become profitable. Okay, and Earnings Hacker was designed to make this possible and accessible for everybody. Okay, I'll talk about that in a second, how many contracts I typically trade ahead of earnings, because that's a very important point as well. But before I do want to offer you guys a chance to purchase Earnings Hacker for the quarter here. We actually just launched this on Tuesday, and we had a very specific number of spots that we were offering to people. Those sold out by Wednesday morning, okay? We knew we had to give this presentation for you guys today. I didn't want to keep you guys from being able to buy it, so we opened up just a small number of spots left for this particular group of people that we're talking to today, so you have the opportunity to try Earnings Hacker for this quarter. It's $2.99 per quarter, but with a special promo code, CTU, and I'll show you how to enter the promo code in a second, you can get this for $100 off, so $199 for the whole quarter, and you will also be grandfathered in at that rate going forward. Once we get through these spots, the price will increase and will most likely go to $3.99 or $4.99 per quarter, but you can lock that in today. And again, comprehensive earnings data for every optionable stock, technical, fundamental, and options data analysis right at your fingertips for every single name, the proprietary ranking system that helps you filter out all of the noise, and trade ranks and possible trade idea generation, 3 sets of historical data that you won't be able to find anywhere else, and it's all available in a very easy-to-use web-based platform. Okay, so I'm going to show you guys really quickly how to use the promo code. So the link here is keenonthemarket.com/CTU. So all you do is type that link into your, or copy and paste that link into your web browser, and you can access this deal here. And I'm going to show you how to use the promo code. Very easy to use. And once you use the code, it automatically gives you $100 off Earnings Hacker for the entire quarter. So you see here, it's here for $2.99. I type in the code CTU, apply, and boom, it's automatically takes $100 off. All right, this is going to be the absolute cheapest. We are offering this for probably the next, probably forever. This is our first release of Earnings Hacker. So if you are interested in trying this, now is the only time really to give it a shot. Please use the promo code. This here one with code. So let me bring that back up here. Sorry about that, guys. So it's regularly $2.99, $1.99 with the promo code. Do you offer a webinar on how to interpret the data and get the most out of it? Yes, it includes an Earnings Hacker trading plan recording, an Earnings Hacker blueprint. You get that all right away, and a how-to video on how to use the product. So yeah, you get absolutely everything you need sent to your email as soon as you make your purchase. Like I said, this is the cheapest we're going to be offering this probably forever. This is the very first release of Earnings Hacker. This quarter is the first earnings cycle that we're going to have it live. So does anyone have any questions about anything we just talked about Earnings Hacker? Yeah, it works well. Yeah, I use it in Google Chrome every day. It works in every single web platform that you would want. Yeah, we designed it to work that way for you guys. Yeah, promo code is CTU. So all you have to do is type in CTU. So promo code CTU for a $100 discount. Okay, so over the course of, is it a separate IC subscription? No. Earnings Hacker provides you Hacker provides you with a Ichimoku Cloud chart automatically for every stock. So you don't need a trading platform that even has charting to do the earnings analysis that Earnings Hacker has. Yes. Yeah, this is the best way to get in on Earnings Hacker because it's grandfathers you in at our introductory price. Trust me, if you want to learn about earnings trading, you want to trade earnings better, this is the best tool around. I know that because my main specialty is trading earnings, and this was kind of developed out of my frustration and kind of lack of resources out there that had this type of information. So yes. Ellen, any live sessions using it? I'm not sure what you mean by that. You get a recording of the trading plan and everything else as soon as you make your purchase. And that's pretty much everything that you need to go ahead and get started. It breaks down all of the ways to use Earnings Hacker, what all the data means to you, how to implement it with the trading plan. It's pretty much all there. Can you guys see the screen? It looks like it's kind of glitchy here. Let's see if I can refresh it. Do you take Iron Condors off before the earnings date? No. The whole point is that I want to hold them through the earnings date. I want to hold them through the earnings date. Okay? I want to hold them through the earnings date. Right? Because that's when the drop in implied volatility is going to happen. As soon as I go through that earnings date and implied vol drops, all that premium that I'm short loses value. And that's the whole idea behind the Iron Condor for earnings. No, we don't track specific stats for this because really, the app provides you information and data to then use, information and data that you wouldn't otherwise have to then use to make your own informed trading decisions, right? So it's hands down the most comprehensive collection of earnings related data that you can find anywhere. Yeah, CTU. It's CTU is the promo. Type it in all caps. You automatically get $100 off. Promo code CTU. Yeah, you can cancel after 1 quarter. Yeah, you absolutely can cancel after 1 quarter. So yeah, for $199, you get the entire quarter access to Earnings Hacker, and in addition to that, you also get all of the rollouts and upgrades that we will be doing for it throughout the first quarter as well. We're going to be adding a whole bunch of different features to it throughout this first quarter as well, and as we do that, the regular price of it is going to go higher. So it's a really great way to get on it now, take advantage of the promo code, and try it out for a quarter. So it gives these trade ideas, but it's not something that is going to be for every single stock. It's only going to give a trade idea when it thinks that there is a good risk versus reward setup. So like for today, for example, in Micron, yesterday Earnings Hacker was saying, hey, Micron looks weak ahead of earnings. A possible put spread is the way to play this. And then Micron sold off on earnings, right? So it only will give a trade when it senses there is a good risk versus reward setup. I do more debit than credit. Earnings Hacker trade ideas will be generated for whichever setup is best determined by our algorithm there. So it could be a credit spread, it could be a debit spread. So does anyone have any other questions? No, I typically do not trade those double diagonals. Calendars are very tough to make money with. Calendars are very tough to make money with. So like I said, we sold out of these incredibly quickly after we launched on Tuesday. We only are offering 25 more spots because we actually sold out of all the ones that we intended to offer at this introductory price before we got to this presentation for you guys. So please, 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 if you want to take advantage of it, use the promo code. After those 25 spots are gone, the promo code is disappearing. See you in the room next week, Kim. And you would have to pay full price. You have update a lot of data. I had the class a year or two ago. How do you update yourself? I'm not really sure what you mean by that. With this purchase, you get the Earnings Hacker trading plan here that is specific for using this piece of software to trade earnings. So if you're interested in that, please use the promo code. Take advantage of the offer from today for today. So do you have statistics on how well this works? Okay, so the problem with determining that is that I can show you all the data. Didn't have the hacker data when you had it. Right. So if you want access to Earnings Hacker, you may have to purchase Earnings Hacker. Earnings Hacker is the only service that includes access to the Earnings Hacker data. Right, absolutely. I mean, if that's something that you want to do, then I can use that historical data range to determine what levels I want to put those iron condors at. Right, so I can use it as a debit spread trader, as a credit spread trader. I could even use it as a day trader who likes to trade stocks after earnings, right? Because I have all this historical data on how a stock typically moves after earnings across a number of key time frames, right? So I can use that information to kind of implement all kinds of different strategies. So any other questions? Any other questions, guys? Please, please, please take advantage of the offer because I will not be able to offer to you again. How does this compare to the other earnings indicator? So that is more of a chart-based indicator. That doesn't have nearly as much data as this one as Earnings Hacker provides, and it also does nothing about ranking the trades in terms of risk versus reward. So I have to already know what stock I want to look at to use that other indicator. This helps me filter out all of the noise and worst probability plays to hone in on what I should be paying attention to, and then I have all of these sets of historical data to then trade those names with. And these these proprietary chart and trade rankings to determine what type of setup I really want to be looking at. So any other questions, guys? Any other questions? How's the success track record for this system? Well, so Earnings Hacker isn't something that is, just generating trade signals or trade ideas, right? It generates information that you cannot find anywhere else. Sometimes it will give a trade idea, right, based on, different conditions being present. But in terms of those specific trade ideas, we haven't back tested them. We just launched the product this week. Yes, this is recorded. This is recorded, absolutely. So I'm going to put the link in here again for you guys with the promo code. Please take advantage. Always like my coaching webinars. Well, thank you. I appreciate that. Right, implied volatility always gets a bit ahead of earnings. Calendars take advantage of that, but they're also very difficult to make money with. If I'm trying to determine what my break even is in a calendar spread, I actually can't even do it. I can't calculate what it is. Right? Even if you put it into your trading platform, it'll approximate what it is, but there's too many variables. I like well-defined risk and reward setups and break-even points. I want all of those things to be defined at all times. I don't want a question mark for any of those categories or considerations. So any other questions, guys? Any other questions? Oh, how many? The code is CTU, all caps. I'll put it in the chat box here again for you. So earnings are, because there's so many earnings, I typically will size all my earnings positions. They're going to be my smallest size trades. Okay, so let's say I normally risk $3,000 to $5,000 on a unusual option activity trade or a swing trade. Then it's not, though. It's situational. But let's say I normally risk $3,000 to $5,000 on a swing trade. Well, for earnings, I'm probably only going to risk between $300 and $500. Okay, so it's not a number of contracts. It's whatever number of contracts equals that much risk. Okay, because think about this. Let's say that I have my account size of 100,000, and I risk 0.5% of my account on each earnings trade. Well, if there's 15 earnings trades in a week, if I'm risking too much, I can lose a lot of money, right? I want my position size to be responsible. But the way that we look at earnings trades, like that ANF example, I tripled my money in a couple of days. So if I lose 2 and win 1, I make money. I'm net profitable, right? But if I'm risking too much money in each trade, then that's just dangerous. So earnings trades are going to be the smallest trades that I take because there are so many of them, right? But I mean, there's weeks where I am able to add several thousands of dollars to my P&L because of earnings trades. That's what I'm talking about: risking a small amount of money via option spreads to make a large amount of money. That's the name of the game with options, and most people don't realize that you can actually lower your risk using options and make more. So does anyone have any more questions? Any more questions, guys? Any more questions? So it looks like we sold out of well more than half of those spots. If you guys are interested in this, it will be taken down sometime tonight. So please take advantage of the offer. I would hate to have one of you call me next week and say, hey, can I get this for $199? Because I'll have to say no. Or our account person will have to say no. But any other questions? Oh, that's possible. I'll have to look into that. But the thing is, yeah, I think that was because there actually is, I think, a couple of reports coming out tomorrow. So at the end of the cycle, unfortunately, if you go look at it right now, that's not going to be very interesting to look at because there's no stocks that are reporting earnings over the next couple of days that are of note. Once we get into this, did you use the promo code, Marcus? Just send an email to us, and we'll take care of that right now. You can send an email to me right there, james@keeneonthemarket.com, and we'll make sure that you get your discount. I apologize for that. What is the reasoning behind the straddle giving you the target? So that's the best way to look at what the market maker's implied move is. So if the market maker is selling the public $10 straddles, then they think the stock's going to move right around $10, maybe a little less, right? The market maker sets that price. It's his move that he's pricing into the name ahead of earnings, right? It's a simpler way, you know, outside of using a calculator and doing implied volatility calculations to determine what the implied move is going to be. Yeah. So any other questions, guys? Any other questions? No, not that I'm aware of, no. Thank you, thank you. All right, guys, so I'm going to put the link and the promo code in here one more time. Please take advantage of that. Very easy to use the promo code. Put in the call is the same strike price is decreasing faster than the call. I'm not really sure what you mean by that. Put and the call decreasing faster than the call. So any other questions, guys? Any other questions? I'm not sure if I... Oh, well, if a stock's moving sideways and options premiums are going down, that's just time decay. That's time decay and implied vol eating away at the premium. So any other questions that you guys might have? I do not, unfortunately. So we'll probably take questions for about 5 more minutes. Any other questions? We had such a nice spring day in Chicago yesterday, and then it rained today. And it's going to get cold again tomorrow. That's why I don't want to go outside. I want to sit here and answer questions. So one decays faster. Right, so I mean, typically speaking, is it really? Hopefully we'll get some. See, you guys always get our weather. That's what it is. You're going to get the cold then probably midweek next week after we get the cold snap here on Friday. Yeah, it's going to be like 25 degrees here tomorrow night. So I see a lot of people typing, so I would imagine there's a lot of questions coming in here. Thank you. Thank you for coming. Yeah, I don't know why. DGLY is up $2 today. I was really focused on some day trades that I had on today. Do I put the order in the morning of earnings or the night before? Okay, so if a stock is reporting earnings after the bell today, I put in the order today. If it's reporting before the bell tomorrow, I have to put the order in today, right? Because the options markets don't trade in extended hours. Okay? Thank you. Yeah, he hasn't sent me an email yet. No, it's not. No, really don't look into that too much there, guys. That's really not. I mean, looking into looking into how fast the decay is happening in different lines, not a way to determine any indications on direction. All right, so just a few more minutes here for questions, guys. Sure. Thank you. So any other questions? Yeah, I do risk reversals sometimes ahead of earnings. It all depends. Typically I'm doing call or put spreads, and then call or put butterflies. But mostly I'm doing call or put spreads. Risk reversals, always have a much better upside potential, but they always involve more risk than a call or put spread does. They always involve more risk. All right, so if there's no more questions, I will thank all of you for attending today. I certainly enjoyed presenting for you guys. I hope you guys found the presentation to be valuable. Talked about a lot of different stuff there about trading earnings. Please, if you're interested in trading earnings, purchase Option Hacker now at the discounted price. If I didn't help build it and get it for free, I would buy it because it is something that I use every single day when trading earnings. So I really, really think it's one of the best friends that a Catalyst trader can have out there, and has simplified my day by orders of magnitude by having all of this information in one place. So thank you guys very, very much. Thank you very much for Cyber Trading University for having me, of course. Everybody have a wonderful evening. Enjoy the day off tomorrow and the long weekend. Thanks again, guys. Everyone have a good night.